More Trendline magic with ICT concepts. This video is for educational purposes only and should not be considered financial advice. As you have seen in our other video on trend lines and ICT concepts, there was a new way to use them together that we discovered. In this video, we will go deeper into this new approach. There are two types of trades that we've seen: a trend line with a fair value gap and a trend line with an order block. This is what the fair value gap trade looks like generically. You have a trend moving upwards, and you follow that trend with your trend line. When there is a fair value gap that takes place, you draw a horizontal line out to where the trend line extends to. Wherever they intersect, that will be your trade entry. And in effect, your trade is off of the inversion fair value gap. This is what the order block trade looks like generically. Again, you have a trend moving upwards, and then when an order block is established, you draw your rectangle out, and 50% of that order block is where you're going to look for your intersection with the trend line, and that will be your entry. As we can see, during the New York session, price moved away from this large fair value gap. Then it returns back to it and hits its 50% mark. Then it creates another fair value gap right after that. Now, what you're looking for using this type of strategy off of a trend line, you're looking for a fair value gap that turns into an inversion fair value gap. And that occurs here. When price moved upward into this fair value gap, it creates an upward fair value gap. And when you draw your fair value gap from there, when price returns back to it, it creates an inversion fair value gap or an inverted fair value gap. Now, interestingly enough, it creates a second downward fair value gap right after that. So inside of here, and let me zoom in, you can see the fair value gap is right here. And inside of this is 50% of that fair value gap. Now, when price moves back up, you want to wait for the trend line to cross that 50% level. And as you can see, if you entered as this is an inversion fair value gap now, if you entered here, you would have to wait for price to get all the way over here before it started to go down. Some people might have a problem holding into that area, especially when price breaks above this swing level. But if you wait until the trend line crosses this 50% level of the fair value gap, that's when you will see price react from. And as we can see, price reacted strongly from that level. And you're looking for a move all the way down to either take out liquidity. It took out liquidity here and it was aiming for this one, but it actually hit probably 50% of this wick. And we can measure that out and we can see that it's probably around 50% exactly of that wick. So make sure that you take some profits on the way down so you can make sure that you don't lose this whole trade. Let's look at another example of our fair value gap with trend lines. In this example, this is what the 5-minute looks like of that situation that we just looked at. We see the same fair value gap is now a wick on this candle right here. And so 50% of the wick can be treated as 50% of the fair value gap. As ICT says, fair value gaps and wicks are very similar. So we can see it all play out pretty much the same inside of this 5-minute time frame. Now, what we're looking for on this 5-minute time frame is the opposite move. On this 1 minute, we were looking for the down move. But now on the 5-minute, we can see there's a setup for an up move. So price did our 1 minute move to the downside, but at the same time, it created another opportunity for an upside move. This fair value gap on this other side, draw a line out of the 50% level, and then your trend line can be drawn right down to it. And as you can see, this fair value gap turns into an inverted fair value gap. Price blew past it, then came back above it, and then it respected that fair value gap and then moved to the upside in a huge way. So in one trading session, you can have a down move trend line fair value gap cross and an upside fair value gap trend line cross. Let's look at the order block. Now in this London session, we have a trend line formed here and an order block here. Price moved down. You can see where price crossed this order block off of this trend line. And if we take our tool and look at where it crossed, it was right here on this candle, this up move candle. That was where it crossed. Now, if you entered, you were still good. You could take the move down to here, which is the beginning of this order block, and also coincidentally the 500 moving average. Now, that would be a decent trade. And if you paid attention, there was a second trend line formed from this swing low to this swing low. And when it crossed that same order block, that's when price really reacted. You could have taken that trade as it was a liquidity grab of these two swing highs, these equal highs. That liquidity grab caused the reaction to go to the downside to take out this liquidity. So both of these trades were valid moves. We hope that clarifies the Trendline ICT strategy that we just found out. We'll do some more back testing and see if there are some ways that we can refine this, but we hope this has helped you and becomes another tool for you to use when you're looking for ICT setups. Thank you for watching, and please subscribe and like the video.